Israel's economy has been immune to what the politics are like. Companies will continue. So.
I the other ones are kind
Okay, folks. My voice is a little in and out. Good news is I don't have COVID, but if you want me to wear a mask, I can. So I just hoarse from a weekend of kind of packing. But I think I'll make it through 80 minutes. So let me get started just in case I run out of steam. So today we're going to complete our discussion, at least the trade-off on dividends. If you remember, I left you with the how tax law can affect how much companies pay in dividends. In what way? When companies pay out dividends, it goes in the hands of investors who get taxed. At what rate? Depends on the country, depends on the time. Whereas if they don't pay the dividend, they keep it just as cash. They don't do anything. It shows up as price appreciation, which gets taxed at a different rate, a capital gains rate. In the US right now, here's what the state of play is. Dividends are taxed at a 20% tax rate. Capital gains, if they're long-term, are taxed at a 20% tax rate. What's a long-term component? What does that mean? What does that require? You got to hold stock for more than a year, 1 year, for it to be long-term capital gain. If it's short-term, if you sell it within a year, what tax rate do you pay? You pay the ordinary tax rate. It gets treated as ordinary income. So that's closer to 40 if you're at the high, 40, it depends on where you are in the country. That's just federal taxes. Then you have state and local taxes. California, for instance, taxes everything at the ordinary tax rate. So if you think about adding all of this up, at least for the moment, it looks like on the face of it, dividends and capital gains are taxed at roughly the same rate. And this has been true only for the last 20 years in the US. The rest of the world, tax laws vary. In Europe, actually, there are many countries, UK and Australia especially, have this phenomenon where if a company pays dividends, investors are allowed to offset what they'd have owed as taxes on those dividends by what the company has already paid. So let's say this plays out. Let's say I'm a company, I paid a 30% tax rate. I now give you $1,000 dividend. And let's say you receive the dividend, you have a tax of 25%. You say 25% of 1,000, but you offset it against the 30% I've already paid. You effectively owe no taxes. It's a way of actually making dividends more tax advantage than capital gains. Put simply, around the world, this varies. In some countries, or many countries, I think dividends are taxed more than capital gains. In some countries, capital gains are taxed higher than dividends. And there are a few countries where neither gets taxed at all. Before I leave this discussion, though, this has become one of the great political questions of the day, right? Especially among populists, as this is unfair, that if you earn a salary, you get taxed at 40, 42%. But if you earn income in the form of dividends and capital gains, investment income, it's taxed at a lower rate. In fact, I think both Elizabeth Warren and Bernie Sanders made that the centerpiece, that they were going to fix this. Now, at one level, it does sound unfair, right? Two different tax rates. But here's why it was something that has to be brought into effect. What do you earn those dividends and capital gains on? Whatever you've invested, right? How do you come up with the money you invested? Well, at some point in time, I mean, unless you have inherited wealth, you earn the money, you pay taxes, you save some of that, you put it into a portfolio, you earn money. It's already on taxed income, then you did the right thing. You were supposed to save, you saved. And now I come back and say, I want you to pay a 40% tax rate on that because everybody else is paying 40%. In effect, you're hitting me twice. Once when I earn the income and you tax me, and now again when I use that earned income. But that's a political discussion that's going to play out in 2024. It's going to become one of the centerpieces, I think, of the campaign, is essentially this debate about tax rates on earned income versus investment income. So the reason I'm bringing this up is this is going to have consequences for dividend policy if it does happen. It hasn't happened yet. But let's continue the discussion. When I took my corporate finance class in 1979, fall of 1979, the dividend section, the dividend analysis focused just on dividends because that's how companies return cash to shareholders. But that's no longer true. If you look at cash return at US companies, and this is perhaps the most striking feature in corporate finance, there's been a dramatic shift in the US away from dividends to stock buybacks. This is not a short-term trend. It's been going on for more than 30 years. Take a look at this graph. It starts in 1988. If I start in 81, it in fact looks even more striking. In 1981, 95% of the cash returned by US companies was in the form of dividends. There are almost no buybacks. Buybacks that happen were very rare. Clearly, something is starting to happen in the 80s. By the time you get to 1988, buybacks are already starting to pick up, but they're still half of dividends. But over time, if you look at the buyback line, it's climbing and it's more volatile than the dividend line. And in 1999, for the first time, or 1998, for the first time in US corporate history, stock buybacks exceeded dividends, and they haven't looked back since. You've had a couple of down years, like 2009, but you look through time, clearly there's a trend away from dividends to stock buybacks. You can't even debate it anymore. The question is why? So I want you to come up with some explanations for why US companies have shifted away from dividends to buybacks. And before you do, I want you to think about that explanation given the trend you've seen. So if you come up with an explanation that was true even before the 1980s, then you got to ask, well, what's changed since? So what do you think has pushed US companies away from dividends to buybacks?
Yeah.
I'm sorry, go ahead.
I was gonna say Democrats, but I mean, Democrats, you said?
Democrats. That's a long-term trend to blame one party on, right? So yeah, Dor.
I would think, but I think it's like the common today that it's more, it gives you more flexibility because
Okay.
like we spoke about
That's-
dividends, you can
So file that away, but that's always been true, right? So the question is, why do companies value flexibility more now than they did 50 years ago? I'll come back to that because I want to put that aside. Clearly, does everybody get Dor's point, which is dividends are sticky, buybacks, you can change your mind. That's nice to have as a company, but why do companies value that more now than 50 years ago? Think about it for a moment. Any other, because I was with Barry Ritholtz a couple of weeks ago and he brought up this issue. But
benefits from data.
so one is tax benefits, but think of what's happened to the tax law. 50 years ago, dividends were taxed at 70%. Capital gains were taxed at 28%. So if there's a tax disadvantage, it was far greater in the 60s and the 70s than it is now. So if it's a tax reason, it's actually cutting the wrong way, right? It should actually be becoming more dividends, less buybacks, because we've increasingly shifted the tax law towards dividends by making the tax rates and dividends and capital gains the same. So the tax reason kind of falls apart because of when it's happened. Yes.
Could be that there are less active investors, so managers
Okay.
have more power and they need that flexibility in order to maintain power.
So you're saying if investors had more power, they push for more dividends, and since investors have lost power.
Well, managers wouldn't try and save their own. Position.
So let's stay on the managers. Can you think of a reason why managers might prefer buybacks to dividends in addition to flexibility? That's for the company, but think of your own interests as a manager. In the 1990s, what was the phenomenon we saw in management compensation? Stock options, right? So think of how stock option works. You get the right to buy a stock at a fixed price. When you pay a dividend, what happens? On the ex-dividend day, stock price drops. It's not neither good nor bad. It's a nature of dividends. Dividends reduce the stock price. So one argument that was presented in the 1990s for why you were seeing stock buybacks take off is as management gets compensated with options, they don't want to give out and they don't want to pay dividends and reduce the stock price. They'd rather use stock buybacks to push up the price so they could make their compensation packages better. I remember hearing this for the first time in like 98 or 99. The way I tested it was I went and looked at companies based on how much of the compensation was an option. The argument being that if a higher percentage of compensation was an option, you should see more buybacks. There's very little evidence of that in the late 90s. But that argument for managers being the reason started to fall apart in 2007 when accounting changed the way it dealt with options. Until 2007, options were like free currency. If you give out options, it didn't affect your bottom line. 2007, accountants started treating options as expenses. And all of a sudden, companies discovered that options were very expensive, as if they didn't know this already. So starting in 2007, US companies started shifting away fairly dramatically again from options to restricted stock. Now with restricted stock, the incentive to not pay dividends is gone, right? Because as restricted stockholders, you collect the dividends. So if options were the primary reason, you should have seen as a kind of at least a drawback in buybacks after 2007. So it's not management compensation. It's not taxes, which brings us back to flexibility. So let's go back to that question. Flexibility is valuable. It's always been valuable, but why is it more valuable in the 21st century than it was for the bulk of the 20th century for US companies? Yes.
Much more like information availability, so that
That's a different issue. We'll come back to that. There's more scrutiny, but flexibility is really about if you don't have earnings, we can't pay dividends, right? So from that perspective, what's different about it?
you have a lot of deficit, like companies with losses.
That too, but the companies doing the buybacks are still money-making companies. The companies today actually make more money than the companies 50 years ago.
Could it be that there are more earning volatility these days?
And why is that? Why are companies more? And you're absolutely right. Companies are more worried about maintaining future earnings now than they were 50 years ago. This is across the world. What are the forces that are causing earnings to become less predictable for almost every company? Phone companies, 50 years ago, predictable earnings.
Because of fact that technology as an industry is going into smaller life cycle.
In fact, let me put the two big buzzwords. I don't like using buzzword, but here are the two buzzwords at work. One is globalization. You're saying, what's that got to do with uncertainty? 50 years ago, you're a domestic company, nice domestic market. You dominated the market. Nobody was coming after your market. You control the market. What does globalization do? It opens up markets to foreign companies coming in. All of a sudden, what used to be a nice, secure market with stable margins has become a much shakier market. This is true across most sectors, across most countries. The other buzzword I'm going to use is disruption. What does that mean? You have sectors that used to make stable, predictable income, and now you have a disruptor show up. And what does a disruptor do? Shake up the business, and all of a sudden your stable earnings are becoming unstable. Now, 50 years ago, if you asked me to list out 200 companies in the US with stable, predictable earnings, I'd have had no trouble. Today, if you ask me to list 20 companies with stable, predictable earnings, I'd have trouble. Even utilities are uncertain about future earnings because now they're feeling the pressures of climate change on the one side, technology delivering energy in different ways on the other side. The world has become a more uncertain place and dividends no longer really make sense. To be honest, dividends never really made sense as a way of returning cash to equity investors. What's the essence of an equity claim? Lenders get a contractual claim, equity gets a Residual claim. What's the essence of it? You get whatever's left over. How can whatever's left over be a fixed number every year? It doesn't make sense. So why did companies get into this trap of paying fixed dividends, you think?
So you said the dividends, like, it shouldn't be used, but you're talking about fixed dividends.
But yeah, fixed dividends, at least the way they've evolved, they shouldn't be used. But why did we get into this trap in the first place?
It was unmanned by people, old people.
Let's go back 150 years. You know what financial markets were first in play? The bond markets. The way people invested 150 or 200 years ago, there was no stock market of any size. They invested in bonds. Bonds came with coupons. Think of yourself as the first person starting a stock exchange. You're going to list stocks. You're trying to get people to buy stocks, but they're used to buying bonds. So what do you tell them? This is just like a bond. We pay a dividend, it'll be just like a coupon. You see how this trap is set early on, right? You start the process off and it builds for a century. That becomes the established way of paying dividends. Is this the case across the world? In much of the world, it's dollar dividends that are sticky. In other words, you pay the same amount. In Latin America, I think you have the only exception. In Latin America, it's not dollar dividends that are sticky, it's dividend payout ratios that are sticky. Companies try to pay the same percentage. You think that's healthy? It might be healthy, but it comes from a very different rationale. It comes from the fact that most Latin American companies, especially if you look at Brazil, at voting and non-voting shares, and one of the conditions for maintaining the non-voting rights on the shares is you had to pay a fixed dividend to those preferred shareholders. So outside of Latin America, much of the world dividends is sticky, and it does mean that you get into trouble when times are bad. Look at oil companies, right? I mean, if you were thinking about how an oil company should set dividends, I would set it based on the oil price. Because when the oil price is 120, I can return huge amounts of cash, but it's $30, I shouldn't be paying any dividends at all. I think that when people complain about buybacks, they're complaining about the wrong side of cash flow. I'd be complaining about dividends. Dividends are what get companies into trouble, essentially keeping them paying dividends while their house is burning down. You should not be doing it. I'll give you the analogy that I think best reflects why companies have shifted from dividends to buybacks. It came to me when my daughter was going to turn 28 next week, was 8 years old. And I was driving her to a birthday party. And I was listening to a jazz station. She said, turn off that nonsense. She was a very assertive little girl. And she said, I'd like to listen to Z100. So I said, turn that on. And I think they play the same song every all day long. And between songs, these DJs come on and talk to each other. I had no idea who they were talking about or what they were talking about. But they mentioned hooking up. To how disconnected you get after 30 years of marriage. I had no idea what they were talking about. So my 8-year-old from the back seat pipes up and tries to explain to me what hooking up is. Now, part of me is in shock. And the other part of me is saying, this is a great way to explain why companies are buying back stock. Dividends are like getting married. In good times and in bad times, in good health or in sickness, for the rest of your life. Buybacks are like hooking up. I don't know your name, but that's okay. No, let's move on. Companies are not interested, and investors either are not interested in getting married. I think it reflects it. I mean, people used to invest in companies and leave their money in there for 50 years for the rest of their lives. That's no longer the case. So I think buybacks also reflect a changing dynamic out there of investors and companies essentially looking at what the cash flows are, collecting it and moving on. And I don't think it's going to change. Now, I know buybacks are made to be a very US-centric phenomenon. They remain the place where they start. And the US still remains the biggest, the highest. So if you look at the last column, that's a percentage of cash returned by 64%. But the rest of the world is not at 0%. Canada is 51%. Europe is at 36%. Latin America is at 27%. This is not a US-centric phenomenon anymore. Companies are catching on that this is a much better way to return cash than get locked in to fixed dividends. Older companies have a problem because they've trained investors to expect dividends. But you know who doesn't have a problem? When Apple matures, it's not going to raise the dividend anymore. It's going to use the buybacks as its primary. It has a small dividend, but it's using its buybacks as its primary phenomenon. And many young tech companies, once they start maturing, are not going to start on the dividend path. Why go down that path if you can use buybacks as a more flexible way of returning dividends? In fact, the India and China, I mean, Africa, I think, has the lowest percentage of buybacks, perhaps because I think there are restrictions in many African countries on buying back your own stock. This used to be true in much of Europe. Companies were not allowed to buy back their own stock. They've removed those restrictions. But India and China have much lower percentages of buybacks as well. Some of that you can attribute to corporate governance, where companies hold back cash. Some of it that they have more growth opportunities, so they don't have to buy back stock. But it's interesting to see this phenomenon kind of play out over time, because I've kept track of this table since the late 90s. Late 90s, if US was a positive number, every other part of the world was at 0%. I've seen the zero shift over time, not just gradually. That's a pretty dramatic move in some parts of the world. Buybacks are here to stay. They're not going away. Of course, you probably, if you were following the tax reform, it was just part of the Inflation Reduction Act, I think, where they put a 2% tax or 1% tax on buybacks. So when a company does buybacks now, it has, has to pay a 1%. It has to pay a 1% tax as part to the government. And it's not going to reduce buybacks. It might mean there's less cash returned overall eventually. But it's something that, there's still this view that buybacks are bad. We need to stop them. And I've never understood why cash return is viewed as somehow a weakness. I mean, if you think about it, cash return is the end game in a business. If you run a successful business, you want cash return. And this notion that whatever is used on buybacks is wasted. I mean, last year, $1 trillion was spent on buybacks. So play the populist role. Play out why that's a bad thing. Play Bernie Sanders in class. So if you were Bernie Sanders, what would you say about that $1 trillion in buybacks? No, forget about even who it goes to. But from the company's perspective, there are lots of people who argue that buybacks are a bad thing. So what do they argue? That the $1 trillion could have been invested back in the company. Implicit there is the assumption that investing back in your business is always better than giving the cash back, right? Do you think, is that true? I mean, what do we see when we looked at return on capital versus cost of capital companies? 2/3 of all companies globally have no business putting money back into. Do you want, or would you have wanted Bed Bath & Beyond to take every dollar of the cash they had for the last 15 years and put it back in the business to do what? Go bankrupt as a bigger company? This notion that investing is better than returning cash is absurd. But here's the other reason the argument doesn't hold up. So the companies paid out $1 trillion in cash. Where did it go? Some of it might have been used for buying a new car by somebody, but ultimately the money has to go somewhere. Where's somewhere else in the market? How do you think all these IPOs, there are people investing in these IPOs, huge amounts of equity flowing in. That $1 trillion is flowing out of companies that are doing the buybacks into companies that desperately need the cash. Now we can debate whether the right kinds of companies are getting the cash. But if you cut off buybacks and you force mature companies to reinvest money back, which a lot of countries are trying to do with their tax law, you risk the worst scenario of all. Your mature companies will be investing in businesses that they have no business investing in. Your new companies will never take off the ground because there's no capital available to them. You'll have what I call a walking dead economy, zombie companies walking around investing in bad businesses and nothing new starting up because you've cut off capital. So I know that sounds like a diatribe, but no, this buyback discussion sets me off because it's built on such fundamental mistruths that unless we confront them, you're going to be arguing on things you shouldn't be arguing. The fundamental truth here is investing is not always better than returning cash. And cash that's returned is not wasted, it's going into other companies. So, yeah, go ahead.
When you do buybacks, will your company have to structure in a way that the people that are not buying that, they also get a percentage of.
Remember, buybacks are voluntary. You get to choose whether to, so when you do a buyback, you let people pick sides. There are two sides, right? In a buyback, there are people selling their shares back and people who stay. You get to pick. Which one should you pick? Your choice. If you think the buyback price is too high, what should you do? Stop bitching and whining about it. Just sell your shares, move on. I don't get people who complain, but the buybacks were too high a price in my company. Why weren't you selling your shares back then? Why are you telling me? When they tell you this is 9 months later after the stock price has dropped, they say, I knew it already. Facebook shouldn't have bought back shares at $300 per share. Really? Then why weren't you selling your shares back at $300 per share? So this argument that buybacks happen at too high a price and therefore it's bad for existing shareholders cuts against the fact that you as existing shareholders chose to stay as shareholders. So that's the best of worlds. You're letting people choose whether they want to stay in the company or leave. They can decide for themselves whether the buyback price is too high or too low. And that decision is going to drive which one you do.
Does this after private companies also?
Private companies, you're the owner, right?
But if you have like a private company with several owners.
Well, then you got an intra-owner issue, right? So if you're going to do a buyback, it's a cash return, and it might make sense because some of the owners might need the cash. And in fact, I would argue that even in private companies, a buyback gives you more flexibility because you have 10 owners. Let's say 3 need cash. Their kids are going off to college, they need the cash. Now, 7 feel pretty, you don't want to pay a dividend because now everybody gets taxed right away. The 3 who need the cash right now are going to go back, and you can do the buyback, they'll sell their shares back. And essentially it gives them, it's flexibility all the way around. People who need cash will then sell their shares back. The only problem in a private company is got to negotiate the price, right? Because there's no market price.
Yeah,
And that's tricky because the wealth transfer is going to be personal. So there will be a tendency on the part of the 7 partners who want to not sell their shares back to get an appraiser to come in and give them a value that is low so that they can get away. And this is where you can get into legal disputes. I mean, a lot of legal tussles, often are 3 or 5 years after the transaction, you get somebody suing, say they paid me too little, right? So that's always the issue with private companies. Without a market price as the arbiter, you run the risk of being accused of playing with the numbers. Any other questions? Yes.
Just gonna ask, is there like a certain percentage or ratio that companies have to have issued, like a number of stocks or a percentage of some sort that they have to have issued to like the public market, or is there not really?
Before they become closely held companies?
Yeah. Consider them to be like basically.
There's probably some restriction, but it's not a restriction that's even close for most larger public. In fact, in some, the Adani group that I wrote about in India, there's a 75% has to be, less than 75% has to be held by what are called promoters, which is the Indian word for founders. So there is, most exchanges have a limit, but they're less restriction on these buybacks. No company that I've looked at has had that issue, but it could become an issue. You're a small company trying to buy back stock, but you can easily get around it, right? The founders can also sell their shares back if that's the only thing stopping you from doing a buyback. Any other questions?
What happens if not enough people want to buy the stock?
Can you raise the price?
But they have to raise the price?
You don't have to, because if you're finding you're raising the price above where we talked about paying too high a price, right? Let's suppose the only way you can do the buyback is by paying too high a price and you don't want to do that. What's your alternative? Pay a special dividend. That's the other flexible dividend policy that companies have seldom used in the US. A special dividend is a one-time dividend. It accomplishes exactly the same objectives as the buyback. The only thing is everybody gets a special dividend. Why is that a problem? Some of those people don't need the cash. Now they have to pay the tax on the special dividend. So there are going to be some pissed off people in there. But that's the alternative to doing a buyback at too high a price. So let's talk about looking at a company. Your question, Terry? No, okay. So let's talk about looking at your company and asking, does my company pay out too much or too little in dividends? So there are two measures of, so let's focus on dividends first, and then we'll talk about what we do with the buyback factor that's kicked in. So these two measures of dividends have been around forever. One is called the dividend payout ratio. What's a dividend payout ratio? It's dividends divided by net income. So for this to be even computed, what has to be true? First, you're going to be paying dividends, and the other is your net income has to be positive, right? Minimal requirements, but you got to make those. If your net income is negative, of course, payout ratio is not meaningful and not available. If the dividends is zero, of course, the payout ratio is zero. The second number is called the dividend yield. It's every value investor's favorite metric. What's a dividend yield? It's a dividend that you're going to get on a share divided by the stock price. Saying, what does that measure? It measures the percentage. Remember, we talked about the expected return on a stock. We used the CAPM and all those elaborate models to get there. I think for Disney, it was what, 9% was the expected return. Some of that return will come from dividends, some from price appreciation. The dividend yield tells you what percent of your overall return is going to come from dividends. The rest has to come from price appreciation. Now, when you look at the payout ratio or yield for your company, first, don't be surprised to see zero. In fact, I'm going to show you the statistic on what percentage of US companies pay no dividends, and it's going to be eye-opening for some of you, because I know for some people it's a surprise. My company doesn't pay dividends. You'll be surprised at how many other companies have exactly the same policy. But if your company does pay dividends, and you want to say, is my company's now that it's paying dividends, is its payout ratio high or low relative to the typical company? Maybe this distribution can help you. This is both US and global companies. And I have the payout ratio. In this case, I have the payout ratio and what I call the cash payout ratio. So the payout ratio is just the dividend portion. Cash payout is dividends plus buybacks. Okay. Among companies that return cash, the median number is about 30 to 40% among companies that return cash. So median percentage of earnings that gets returned in the form of dividends and buybacks is about 30 to 40%. That's a median, but you can see there's a huge distribution. At one end of the distribution, you have over 100%. At first sight, that sounds absurd, right? That you're making $100 in earnings and returning $150, $170, $100, $200 in either dividends and buybacks. Are these companies crazy? Some of them might be, but what are the companies that you think need to be in that more than 100%? We'd expect them to be more than 100%. Yes. One is declining the life cycle, right? And you're declining the life cycle. What should you be doing if you're sensible? You should be cashing out your businesses, returning more than your earnings because you want to liquidate yourself over time. Think of how much more pleasant. I hate to pick on Bed Bath & Beyond. Actually, I like to pick on them. Think of how much more pleasant the end game would have been if 7 years ago they decided, you know what, nobody's going to come into our stores anymore. So you know what we're going to do? Every year we're going to shut 25% of our stores and gradually liquidate ourselves and pay down the debt. It's a kind of a healthy way to kind of ease out of existence, if there's such a thing. So one is declining companies. What else? Who else might be in here who is not? So of course they're crazy companies, but what other rational explanation can there be for payout ratio being greater than 100%? We call dividends was sticky, right? So let's say you're an oil company with sticky dividends. What's going to happen to your payout ratio? In good times, it's going to become very low. But in bad times, you will preserve the dividends because you expect to come out of the cycle. So if you have cyclical commodity companies or commodity companies, you'll end up here in the years where your earnings are down because your payout ratios, it's not because you're being crazy, but because you're smoothing things out. So dividends, you're just smoothing cash returns out. The danger, of course, is you don't come back from the cycle, you're in trouble. But companies have done this for as long as time. So take a look at your payout ratio. And the reason I said don't be surprised is those are the statistics for US companies and global companies. 53% of US companies do not pay dividends. So here's a nice trick question to ask when you're on the other side of the interview table. So right now you're on the wrong side, but when you get on the right side, you're up against a very cocky MBA, thinks he knows everything. Ask that person what the median dividend payout ratio is for a US company. What's the right answer? What percent of companies don't pay dividends? 50. I didn't say median payout ratio for a dividend paying company. I said, what's the median payout ratio for a US company? The answer is 0%. You're past the 50% line. Remember, the median is the 50%. So keep that answer away, put it in your pocket. And maybe 3 or 4 or 5 years from now, you can use it on somebody you really don't want to work at your company and you want to cut them down at the knees. Good question to ask. Or you can ask it around bankers and see how many of them get the right answer. That's the payout ratio. Let's look at the dividend yield. Tells roughly the same story, but there's an interesting twist or an add-on to the story. So you can see this is again among global. So these are the, sorry, this looks like the payout ratio again, right? I've got the wrong table. But imagine that this was the dividend yield table. I'll replace it later and put up the new slide. The dividend yield table, the median dividend yield for a company now is about 2%. If you include buybacks, it gets a little higher, 3.5% maybe. But keep that in mind. You're not going to get rich investing in stocks if all you do is collect dividends. A dividend is not a glorified bond. Dividends, a stock is not a glorified bond. Dividends are only a piece of your returns. You need price appreciation. And you saw with years like 2022, you can have bad years and good years. So you need that expected price appreciation over time. But with dividend yields, you do get this interesting group of companies which look too good to be true. What's a T-bond rate right now? Like 3.6% or so. There are companies out there with dividend yields of 8, 10, 12%. This sounds amazing, right? You're essentially buying a stock and you're getting a yield that is higher than what you can make on, forget about a T-bond, on a corporate bond. This is 8, 10, 12%. If I get that and I get price appreciation on top, I'm going to make so much money. Don't buy those 8, 10 or 12% dividend yields, because when a company has an 8, 10, so what's a number that pushes the dividend yield to 8, 10 or 12%? It's not the dividend going up, it's the price going down, right? So before you freak out and go and buy the stock, the question you got to ask is, what's causing the price to go down? Remember, the price is an updated number. Your dividend reflects what they did in the last 12 months. God only knows what they've done in the last 2 months. So I'm not saying an 8, 10, 12% might not be a great investment, but all too often it's a reflection of the fact that you're buying companies just ahead of a crisis, a precipice where the company is going to say, guys, we're not paying dividends anymore. You're saying, I'll sue the company. Good luck with that. Dividends are not a contractual claim. The fact that you bought the dividend based on the yield doesn't mean you're guaranteed the yield. This is not a coupon where you can say, I deserve that coupon, that's why I invested. So dividend payout ratios measure the percent of net income return, and don't be surprised to see 0% or over 100%. And dividend yields reflect how much of your returns come from dividends. That number is about 2 to 3%. It was as low as 1.5% at the start of 2022. It's now up Not because dividends increased, but because the market price dropped. Again, remember, that's the biggest reason yields change over time. It's the market price changing, not the dividends themselves. So let me give you a very simple template for thinking about how much a company should return to its shareholders. It goes back to life cycle. I've used it before and I'll use it again here. Early in the life cycle, you have no business returning cash. Why? Because you need every dollar that you make to go back into the business. A young startup or a young company or a young high growth company that pays dividends is asking for trouble. Now, one of the things I think we've talked about is companies not acting their age. Young companies that pay dividends are not acting their age. They have a combination of circumstances that should make them not pay dividends. They're often not making much money. They have huge reinvestment needs because that's where the growth is going to come from. And you factor those in, the potential dividend should be zero. As you mature as a company, your earnings start to build up, your reinvestment needs start to drop. Exactly at the same time, your capacity to borrow money starts to open up. Your capacity to pay dividends also opens up. And as with borrowing money, most companies, when that capacity opens up, will be in denial. They say, we're still a growth company. We're not going to pay dividends. So let's see what's happening. You're maturing as a company. Your capacity to pay dividends is opening up. So you have cash flows. You're refusing to pay dividends. So where does that cash go? Remember, this is cash left over after reinvestment. Where's the only place left? If this is the cash left after reinvestment and you're not paying it out, it goes into your cash balance, right? So guess what happens to young growth companies as they mature? The cash balances start to balloon up. You've seen this happen in tech companies. All of a sudden, you've got 50 billion, 70 billion, and the managers always act surprised. How the heck did that cash show up? It's a direct consequence of you choosing not to return the cash. So one way to tell when a company is maturing is when its cash balance starts to balloon out very quickly. It doesn't make them a bad company. It just means that their 20%, 25% growth days are done. They're starting to mature as a company. They have the capacity to pay the dividend. They're choosing not to. Now, could somebody make them pay dividends? You or I might not, but a Carl Icahn might, or an activist investor might. And those then become the targets of companies where investors target them, say you should return some of that cash to your shareholders. And just to back that up, if you look at dividend yield and payout ratios based upon expected earnings growth, there's a very clear link. High growth companies tend to have much lower dividend yields, much lower payout ratios. What you expect to see, but nice to see the data kind of back you up, is as your growth rate. So that's the expected growth in earnings. And as my expected growth in earnings goes from 0 to 3% to more than 25%, my payout ratio and yield numbers both start to drop off. So those of you who have a high growth company as your company, and you see that, look at the dividends and there are none, it's exactly what you would expect. But if any of you have high growth companies and you look at the dividend line and there is a dividend, the question you got to stop and ask is this company acting its age? Is something going on here that might cause the company to pay a dividend? So let me focus on my companies and look at their dividend yield and payout ratios. So here you have Disney, Vale, Tata Motors, Baidu, and Deutsche. Baidu was my easy one, 0, 0, 0, 0. No dividends, no buybacks. Okay, that's out of the way. But if you look at Disney and Vale, you can see the numbers shift around. And for Deutsche Bank, it looks like they're certifiably in sync, right? 362%. Now I'm going to cut them some slack. They probably thought they were going to come back. Why they thought that, I don't know, but they thought they were going to come back. Income would come back. Biggest bank in Europe. I mean, this how long can the bad times last? And this is when you don't tempt the gods, I guess, because the bad times can last a long time. But you can see how companies hold on to dividends. And it's part of the reason I think banks get into the trouble that they do is banks, because they tend to be older companies, have built up a shareholder base that expects them to pay dividends. And that means that sticky dividends really comes back to hurt them during bad times because they continue to pay dividends. In any sensible world, Deutsche should have stopped paying dividends in 2009 because they were already in trouble. but they kept paying it because I remember talking to it was a mid-cap bank CEO in 2009. I knew what the regulatory capital looked like. It was horrible. Every news story about the company is awful. So as the CEO, why do you keep paying dividends? And he said, we don't want to send the wrong signal to the market. I said, you in denial? I mean, market knows exactly how much trouble you're in. How much more of a signal will this be to admit that you're in trouble? Because that's all this is saying. So I think when you have dividends and you have bad times, sometimes those dividends can make those bad times worse because you're digging a hole for yourself that gets deeper each time you pay a dividend. Vale, another company that's expecting the cycle, the same cycle that allowed them to explain away how capital structure is okay because iron ore prices, you can see that play out in dividend policy as well. So you can see what managers think about how their earnings will behave in the long term can sometimes affect how much they continue to pay in dividends. So I'm going to give you 3 schools of thought on dividend policy. They kind of cover the spectrum. So no matter what you think about dividends, you have an entire school of thought backing you up. The first school of thought says, it doesn't matter how much you pay in dividends. Your value as a firm is going to be a value as a firm. Doesn't matter how much you pay in dividends. Doesn't that sound a little familiar? When we talked about capital structure, wasn't there a doesn't matter theorem in capital structure? The Miller-Modigliani theorem said it doesn't matter how much you borrow. This is Miller-Modigliani too. It doesn't matter how much you pay in dividends. In a Miller-Modigliani word, we could have stopped this class after 8 weeks and said, we're done. This investment policy is done. Doesn't matter how much you borrow. Doesn't matter how much you pay in dividends. Again, I'll take you through the logic, and the logic is impeccable, and it gives you a starting point for thinking when dividends matter. But the Miller-Modigliani theorem basically says in a world where investors are taxed the same way on dividends and capital gains, and the way companies invest is not changed by dividend policy. That sounds a little mysterious. It doesn't matter how much companies pay. They can pay too much, they can pay too little. The effect on value is zero. The second group is much easier to understand. I told you for a century, from 1915 through 2003 in the US, dividends were taxed at a much higher rate than capital gains. And starting in the late 60s to 70s, there was a school, in fact, my dividend chapter in corporate finance, my corporate finance textbook that I had was titled The Dividend Puzzle. Why do companies keep paying dividends? Look at the tax law. So the second school of thought says, given the tax disadvantage of dividends, and this school was evolved during the second half of the 20th century, companies shouldn't pay dividends. Paying dividends actually reduces your value because it makes your investors pay a higher tax rate. So dividends don't matter, dividends are bad. Let's complete the cycle here. There's a third school of thought says, well, if your investors like dividends, just like the customer is always right in marketing, investors like dividends. That's what they want. Paying more in dividends will actually increase value. You see how this is great for a CFO. No matter what you do as a CFO, you got an entire school of thought backing you up. You cut dividends, you say dividends are bad. You raise dividends, dividends are good. You have no idea what you're doing with dividends. You say, I'm the Miller-Modigliani school. It doesn't really matter. So let's look at these 3 schools of thought because there are elements of truth in all of them. And I'm going to try to create a consolidated version where I'm going to borrow from each of the 3 schools and give you what I think is a sensible kind of summary. So here's how I'm going to come up at the end of this discussion. I'm going to argue that if you have a company with a lot of cash, relatively few investment opportunities, then you should be trying to return more cash to your shareholders. That sound reasonable to you? Okay. Now, we haven't defined what we mean by a lot of cash. We haven't defined what we mean by investment opportunities. But if I can do that, that seems like a sensible thing to do. Conversely, if you're a company that has not that much cash, lots of investment opportunities, then you shouldn't be returning cash to your shareholders. We'll get to that because we have to define cash and opportunities, but that's going to be my end game. So let's start with the Miller-Modigliani school. Okay. Again, I could prove this algebraically, but let's try to do it intuitively. let's say you have a company which has 100 million it can pay out as a potential dividend. It's the cash left over after every single investment. Let's work through the scenarios of why you as an investor worry when the company doesn't return that cash. First, if the company chooses not to return the 100 million in cash, what happens? Becomes part of the cash balance, right? By itself, that doesn't hurt you. Because it's earned at a fair market rate, it's like a zero net present value investment. So why do you worry about companies not returning cash to you? What do you worry they might do with the cash? Stupid things. An acquisition, a bad project. Why? Because they're cash on their hands. So one of the things you know what the Miller-Modigliani theorem says, look, companies are going to invest in good projects. Having cash is not going to change those investments. So you don't have to worry about companies returning too little in cash. It'll just stay in cash. So companies returning too little in cash doesn't hurt you. It's like having a cash balance in addition to the investment in the company. I mean, I've been a stockholder in Apple now off and on over the last 10 years. And every time I invest in Apple, I have to remind myself that I invest $1 million in Apple. I've actually invested $200,000, depending on the point of time, or $150,000 in T-bills. Why is that? You buy $1 million of Apple shares. Why are you effectively investing $150,000 in T-bills? It's because Apple, if you take the breakdown into operating assets, a $2 trillion company, at the peak, it had $250 billion in cash, $1.75 billion in operating assets. You buy shares in the company, you're getting a share of the $250 million cash. Don't do something stupid like write checks against that cash balance. That's not going to end well, but it is technically your cash. So a company that has, so think of those as neutral companies, companies where it doesn't pay dividends, the cash goes into a cash balance, and the company doesn't have a history of doing stupid things. You know why I admired Tim Cook so much? Can you imagine for the last 12 years, how many investment bankers and deal makers must be lined up outside one infinity loop, pitching him deals he can make? Because when you see $250 billion and you're a banker or a deal maker, your eyes light up, right? I can sell them. Disney, why do you buy it? I've heard, the kinds of companies I've heard people that Apple should buy, just mind-boggling. Buy Tesla, buy Netflix, buy Disney. Thank God Tim Cook doesn't listen to any of this stupidity. Because the minute he did that, I'd start to worry about that $300 billion or $200 billion cash balance. The fact that he hasn't done it means something. Look, it's a cash balance. Let's take the other side of the extreme. You could return 100 million. Returning less is not a problem because, at least in the Miller-Modigliani world, every company behaves like Apple. It doesn't screw with your cash. What happens if a company returns more than it should? What do you worry about as an investor? So instead of they can return 100, they choose to return 200 million. What's your first worry? Well, where's the extra 100 million coming from? Is quite the first question, right? I could borrow money, which pushes me off my right debt ratio, which might put me into trouble. It could be that I don't take projects that I should be taking, even though they're good projects, because I would. So normally when companies return too much in cash, you worry about them not investing in projects they should or borrowing too much. In the Miller-Modigliani world, neither possibility exists because companies continue to take the projects they did. Say, where are they going to come up with the extra 100 million? In the Miller-Modigliani world, they don't borrow the money. They go out and raise fresh equity. Now, when I say that to you as a company, that I'm going to pay 200 million in dividends, excuse me, 200 million dividends, and 100 million is going to come from equity I raise, what's your first reaction? Are you out of your mind, right? And why? Because 100 million fresh equity I raise is going to come with issuance costs. I've got to pay investment bankers. I've got to pay transactions costs. You know what happens in the Miller-Modigliani world? Those costs don't exist. I know it's a very simplified world, but it's a good place to start of when do dividends don't matter. Dividends don't matter if companies' investment policy is unaffected by their dividend policy, which is asking for a lot. Where there are no transactions costs and issuance costs from raising fresh equity, then it doesn't matter how much you pay in dividends because as an investor in this company, I'm going to end up with exactly the same return on my stock, no matter what you do. So think of that as a limited case. That's the scenario where dividends don't matter. Let's turn to the second school of thought. Dividends could hurt me. And this is, as I said, based on taxes on dividends being higher than capital gains. So this is a graph starting in 1916 of dividends and capital gains. So the purple line is the dividend tax rate, the green line is the capital gains tax rate. When you can't see both, it's because they have the same tax rates. So starting at least, I think the earliest I could find a capital gains tax rate was, I think, 1922, all the way through 2002. The capital gains tax rate on long-term capital gains has been much lower than the tax rate on dividends. And this is the highest marginal tax rate. So keep that in mind. It's not for everybody. It's at the highest marginal tax rate. So if you look at the 1950s, there's a tax rate on dividends, 90%. Why do you even bother mailing the check to me? Just mail it directly to the government, right? 90% is gone. And there's a capital gains tax rate, 25%. Talk about when you should be buying back stock. That's when you should have been buying back stock like crazy. But companies continue to pay dividends. And that's why the tax argument for the buybacks kind of falls apart, because the tax argument was far stronger in the 50s and the 60s. 1986, there was a brief moment, and I remember 1986, there's a tax reform act of Congress, and they said, this is it. We finally have come to sanity. We're going to have a 28% tax rate on everything. Everything, income, dividends, capital gains. You know what the healthy thing about having one tax rate and everything is? You don't get tax gains or you're moving things around. It's not worth your effort. And think of how much of the economy is spent moving things around so dividends can become capital gains, or capital gains can become something else. 1986, you're saying this is good, but moments of sanity never last long. And by 1989, they were back to tinkering again with the tax law. And you can see the opening again, that's the 1990s. And then in 2003, the tax rate on both dropped to 15%. We talked about the cliff in 2012. And 1 week before the cliff expired, Congress got its act together, if you can call it that. And they preserved the same tax rate for the two, but they raised the tax rate on both dividends and capital gains to 20%. The Obama healthcare plan also added a Medicare tax of 3.8%. So you add things up, it's a 23.8% tax rate on dividends and capital gains right now for the highest marginal tax rate individual. But the tax rate, so at the moment, it seems like dividends and capital gains are taxed at the same rate, right? But I'm going to argue there's still a tax benefit you get with capital gains relative to dividends. What is that tax benefit? When do you have to pay taxes on dividends? You don't have a choice, right? The company pays a dividend. At the end of the year, you get a statement from the company saying we paid you the dividend, or from your broker if you held it through. You got to pay the dividend. You can't tell the IRS, look, I didn't need the cash this year. Can I pay it 5 years from now? You can try that. It's never worked for me. You got to pay it when you. In contrast, when do you pay taxes on capital gains?
You're after you sell the stock.
First, you have to sell the stock. It's when you decide to sell. And that can affect your taxes. Why? Because you might choose to sell in a year when you have less ordinary income, therefore you have lower tax rates. And in the US, there is another way you can reduce the taxes on capital gains. Just hold on till you die. I know it sounds morbid, but in the US, when you die, your basis on your investments are raised to market value. You get a one-time deal on capital gains, effectively passing through to your successors. To me, that's, I think, if you're going to fix the tax law, that's what you need to fix, because that's what you're saying is unfair. I agree with you, is that one-time basis kick up is essentially a kind of a special deal on capital gains.
What are you saying, that you don't pay taxes?
You don't pay taxes on it. It's a one-time deal, but you have to die. So that's a trade-off. You get this tax benefit, but you got to die to get the tax benefit. I'm not sure I want that trade-off, but your sons, your daughters, your grandchildren might like it anyway. So that's the inheritance tax. No, I won't call it a loophole. It was put in for the best of intentions. It was put in because if you mark up to market things that are not liquid, let's say you own a farm, right? You bought it for 100,000 in the 1950s. It's now worth $15 million, maybe even 50 million. You die. I mark it up to market and I say you owe 20 million in taxes. How the heck are you going to even come up with the 20 million? So essentially the reason they allow the markup is otherwise you'd have businesses liquidating like crazy when their owners die. So there is this, it's not an easy fix, but just say, let's just mark it up. So it's something that has always been an issue in tax law, but it does create this tax benefit for capital gains that you don't get with dividends. Now, one of the things that would be nice to know when you look at a company is, hey, what kind of investors, because remember, that's at the highest marginal tax rate I've told you, right? So as you go down, among individuals, tax rates change. So if you're an older investor and you receive dividends, especially if you're on Social Security, the dividends might effectively be tax-free. And if you look across investor types, a pension fund, how much do pension funds pay as taxes on dividends? Zero. Pension fund pay taxes on zero tax on capital gains. So across investors, you have very different tax treatments. And even within investor portfolios, you can get very different tax treatment on different parts of your portfolio. What am I talking about? I mean, most of you, if you worked at a company where you're given the chance of opening a 401k or a pension plan, money that goes into that pension plan can effectively build up income for you tax-free till you retire. In effect, you're like a pension fund on your 401k because you don't have to pay taxes. It just builds up there. You can already see that this notion of tax difference is not something that applies across all investors. So when you look at a company, you might ask, hey, what kind of investors own stock in this company? And I'm going to give you a trick. It doesn't always work well to figure out who the investors in a company are. And it comes from looking at what happens on the ex-dividend day. You have no idea what the ex-dividend day is? Okay. Dividends, actually, there are 4 dates of notice. First is there's a dividend declaration day. That's the day the board of directors gets together and declares what the dividend is going to be. That happens first. Okay. So that's the day the stock price will react. So an increase or decrease. About a few weeks later, there is a date on which the books will be closed. In the old days before computers, the books are actually closed and you got a record of all the shareholders in the books. Why? Because you had to mail them checks. That's called the ex-dividend day. Which means if you bought the shares before the ex-dividend day, you got the dividend. But if you got it after the ex-dividend day, you didn't get the dividend. Part of you saying, I always buy before the ex-dividend day. We'll talk about what's going to adjust to make it so that you're okay with doing either. So the ex-dividend day is the date in which ownership of the dividend passes. And there's one final day, which is the actual payment day. Declaration day, ex-dividend day. Yeah. And the language that gets used is cum dividend, ex-dividend. Cum dividend means you bought the stock before that list was closed, so you get the dividend. Ex-dividend means you bought the stock afterwards. So looking at the ex-dividend day, here's what's going to happen. Okay. So you let's say we've all bought shares in the same company. We bought it 5 years ago. Okay. So I'm going to bring it because that makes it long-term capital gains for all of us. Tomorrow is going to be an ex-dividend day. You know that if you buy the shares after, if you sell the shares before the ex-dividend day, you lose the dividend. If you hold on that extra day, you get the dividend. So part of you saying, well, always hold on. But the market price will reflect the fact that after the ex-dividend day, people will not get the dividend. So you got a price before the ex-dividend day, a price after the ex-dividend. I know this is sounding abstract, but hang in there. So here's what we have. We know what the dividend is going to be. How do we know? Because by the time you get to the ex-dividend date, remember the dividend already been declared. There's no uncertainty about the dividend. We know the price right now. And we know at the end of tomorrow, the price is going to be lower or higher. If it's higher, I'll always hold on to the stock because then I'll get the, it's going to be lower. After the ex-dividend day, the people buying the shares are not going to pay as much. That's a good question. There's a price before, price after. The question you're facing is, should I sell now and lose the dividend, or should I wait and collect the dividend and sell tomorrow? So let's set up the cash flows. If you sell before the ex-dividend day, you're going to get the price, you're going to get the capital gains, but you're going to get no dividends. If you sell after, you get the capital gains at the new price and you get the dividends. Now, for everybody, if this number is higher than this number, what's going to happen the day before the ex-dividend day? Everybody's going to be selling. The market's going to be in complete chaos, right? You're going to have all sellers, not buyers. And if for everybody, this number was higher than this number, nobody will sell before, and everybody. For this market to be stable, for most of the investors in the company, these two numbers have to equate. In other words, you have to be indifferent between selling before and selling after. Otherwise, the market's going to be unstable. So I'm going to set up an algebra. So if I said the two equal and I solve for it, I know you kind of wiped it out. You get the change in the price on the ex-dividend day as a percentage of the dividend. And it's going to be driven by what taxes you pay on dividends and what taxes you pay on capital gains. The only scenario where the price drop will be exactly equal to the dividend is if your tax rates on dividends and capital gains are the same. If they're taxed exactly the same and you feel indifferent between the two, then the price drop on the ex-dividend day is going to be exactly equal to the dividend. If you're taxed at a higher rate on dividends and on capital gains, on the ex-dividend day, the price is going to drop by less than the dividend. Why? Because you'll accept lower price capital gain over a higher dividend because you're going to get taxed more. If conversely, you're taxed at a higher rate on capital gains than on dividends, there are some parts of the world where that's true. On the ex-dividend day, price change will actually be higher than the dollar dividend. You think, so what? Remember I said you want to think about who the investors in your company are. You can't go asking investors, what their tax status is. They're not going to answer you. But you can observe what happens to the stock price of a company in the ex-dividend day. And if you can observe it over a bunch of ex-dividend days as a percentage of the dividend, you can start to at least form judgments about, hey, are the investors in my company investors who are taxed more heavily on dividends or on capital gains? Let's say all the investors in your company are pension funds. You know what you're going to see on the ex-dividend day, right? The price drop is going to be roughly equal to the dividend. If all the investors in your company are rich people who hate dividends, the price drop on the ex-dividend day is going to be small relative to the dividend. And conversely, if you have a company where everybody's an older investor saying, I don't get taxed on dividends, capital gains are a pain in the neck, you could get the exact opposite effect. So that's something that has been studied now for almost 60 years. In fact, the very first study so basically these studies, all they do is they look at the ex-dividend day for every US stock. They look at the dividends, they look at the price change. It's a very simple computation. They compute what it is on average across companies. Why do you have to do it across companies? Because in any given stock on any given day, God only knows what will happen. But across thousands of companies and across thousands of days, you can compute that statistic. In fact, the two professors who did that very first study, Ned Elton and Marty Gruber, used to teach here until they retired just a few years ago. Yeah. They did the very first study looking at 1966 through 69 data. In those days, they actually had to hand collect the data, so hats off for the kind of research that's required. But they found that on average, the price change as a percent of dividend in that time period was 78%. What does that tell you? It tells you that at least in that time period, investors felt they were taxed more heavily on dividends and capital gains, and they probably had good reason to. That was when dividends were taxed at 70%, capital gains were taxed at 28%. So the price change was 78 cents for every dollar. Take a look at what's happened to that statistic over time. In fact, I saw a recent study, 2021, that looked at it's now, I think, at 96 cents for every dollar in dividends. There's a 96-cent drop on average on the ex-dividend day. So it's moved from 0.78, 0.96. And that's exactly what you saw in the chart, right? As the difference in tax rates has converged, but it hasn't moved to $1. In other words, it's not completely closed. And that creates opportunities for a subset of investors. And here's what I want you to think about. Let's say that you decide, based on these studies, that on average, the price drop on the ex-dividend day is going to be 90% of the dividend. how would you, and let's say you're a tax exempt investor, you're not taxed on dividends and capital gains. How would you go about taking advantage of this divergence between the dividend and the price drop on the ex-dividend? What would you do?
You get the dividend.
Well, I mean, you're up to, you can create any strategy you want. So, what would you do? Option B, which would be to sell short, and you'd have to pay the dividend, right? I think you'd be worse off. So you buy at the close just before the ex-dividend day. You hold it to make sure you get the dividend. You sell at the lower price. You're saying, that's bad, I will lose 90 cents. But you collect the dollar in dividend. It's called dividend capture, dividend arbitrage. And there are pension funds that have played this game for 50 years. On the ex-dividend day, that's what they do. They will come in and buy 1 million shares of a stock cum dividend, hold it just long enough that they become the official owners of the dividend. And so you're saying that's so unethical. No, it is taking advantage. In fact, the different tax rates in the market, you are going to create opportunities for people with tax status very different from the typical investor. So you'd have to do this, don't do it on 1,000 shares. It's not enough money to make, you'd have to do it in tens of thousands, millions of shares. So this is an example of a classic ex-dividend. You go and buy 1 million shares of cum dividend at 50, wait till the stock goes ex-dividend, collect the dividend. And if everything goes as planned, you're going to make about $100,000 on this over a very short period. So what could throw off your plan?
Fees.
The fees I can live with. I'm doing this in bulk. I can arrange for low cost. The costs don't bother me because many of the companies you're doing this on are mature companies. There's not much of a bid-ask spread, so I can cover all those costs. Unexpected event. If I'd done this on October 19th of 1987, let's say that tomorrow, it's October 18th. I read all these studies. I said, tomorrow, stock is going to have a $3 dividend. On average, the stock price will drop by only $2.70. So I'm going to go buy shares today and wait just a day. What can happen in a day? What can happen in a day? October 19th of 1987. What happened that day? The S&P 500 dropped by 22%. You know what this strategy is going to look like? It's going to make you bankrupt. This is actually a true story. A pension fund in Oregon, the pension fund, the guy who ran the pension fund read up these studies on dividend capture, thought this is so clever, I'm going to do this. He made this supreme mistake of taking 40% of the pension fund, putting it on one stock before next dividend day, which happened to be October 19th of 1987. And the rest of the story is too gory to tell. But you can see exactly what happens there. So if you're going to do this, you can't do this on one stock at one point in time. You got to do it over dozens of ex-dividend days over time and hope that the other effects, things you can't, the unexpected events average out. So dividend capture, dividend arbitrage just reflects the fact that ex-dividend day behavior reflects this different tax status investors playing out the game. And you can see the potential for making money has dropped significantly over time because more and more people can play this game. And it's gone from 78 cents to 97 cents, which means you got to do it in big quantities with very low transactions costs and over lots of different stocks for it to even make sense.
But you can buy a put with very short maturity or like the conversion.
You could, that start wiping out. Remember, the premium on a put on the market is going to be so immense that if you add up the costs of buying market protection,
But it's a short maturity.
even short maturities, you'll be surprised at how much of you could try. I mean, it might be worth trying because seeing if you can protect yourself against it. That protects you against the market component of the unexpected. You know what it might not protect you against? Tomorrow, the CEO of this company that's doing the ex-dividend announces he's taking a leave of absence for whatever reasons. So there are lots of other, so unless you can protect against all of those, you're really still exposed. But you can protect against the market part, you're right. So let's talk about, yes, go ahead.
Your life, as you say that all the pension funds are doing this.
Not all of them, some of them are, many of them, no, this is not it, but some of them, this becomes part of a much wider set of strategies. It's not how they make, it's like adding a little icing to the cake on what they make as returns, but some of them are.
I was wondering, wouldn't the selling price like drop?
If enough players play it, that's what's moving it to 97 cents, right? So that must be where the marginal cost of the last pension fund is equal to the marginal return. But remember, larger pension funds might have lower transactions costs than small. So this is almost, you keep doing it. So it's like classic econ where you hit to that marginal point of the next pension fund looks at it and said, we can't make money at that. Our transactions cost a little higher than the previous pension fund. And that's what keeps it from going to one, is that transactions cost and other frictions in the game. Yeah. So let's talk about two bad reasons for paying dividends and hold off on the good reasons perhaps in the next session. The first is what I call the bird in the hand fallacy, which I've heard from a lot of value investors from the investing side. And here's the rationale for why they claim dividends are better than capital gains. They say dividends I receive in my hand. I know exactly what they are. Capital gains are uncertain. Who knows what the stock will be 2 years from now? That sounds pretty reasonable, right? Dividends are certain, capital gains are uncertain. What's the flaw in that comparison? Remember, dividends come out of the stock price today. So what should we be comparing the capital gain to? Dividends today versus a capital gain today. They're equally certain. You're doing them at the same time. It's not dividends today versus capital gains in some unforeseen future. So the reason you're paying dividends is because you think investors will reward you, because they're most certain you're barking up the wrong tree. There is zero evidence that paying dividends pushes up your stock price. It attracts a different set of investors to your company. But investors will not reward you for dividends being more certain than capital gains. The second reason you will hear is we have lots of money this year. We had a good year. Why don't we just return the cash as dividends? What's the problem? You start paying dividends because you had a good year. Unless you have the courage next year to come back and say, we didn't have a good year this year, you end up caught in a dividend policy that you now can't afford. And especially if you're a company which might have great investments, let's say your investment opportunities go up and down over time. Next year, if you need the cash, you have to go out and raise equity. You don't live in a Miller Modigliani world where it costs you nothing to raise money, especially to raise fresh equity is much more expensive than raising fresh debt. I mean, you're on transactions cost. What percentage of the money you leave on the table for equity issuances? True, larger issuances, the costs are smaller, but they're not zero. You think, and you can compare them to the cost of issuing bonds. So if you decide to pay dividends because you have a good year, and then you find yourself having to issue stock to make up for it, your investors are being hurt because of the costs you're going to face as a consequence. So don't pay dividends because you think investors will reward you because they're certain. Don't pay dividends just because you had a good year. There are three good reasons for paying dividends. We won't look at them in detail today, but let me list out the three. If you get investors who like dividends, it's called a clientele effect. And I think I mentioned this in the last class. You get the investors you deserve. As a company, I set a dividend policy. Investors look at the dividend policy. Some of them would dislike it. Some of them will like it. They will become shareholders of my company. And once they become shareholders, that's what they want to see more of. There's a very strong clientele effect in dividends, which is your investors decide what they like, and then you better feed them more of that or they're going to be unhappy. So the clientele effect says, depending on who's investing in your company, I'd have to pay more in dividends because that's what they want. We'll talk about the clash that might create in some companies. You see why? Because you accumulate a clientele that likes dividends as a mature business, and all of a sudden you decide to become a growth business again. We'll talk about what do you do then, because I think somebody raised that potential last class, but I think that's one of the most difficult scenarios for a company is what do you do if you've accumulated a shareholder base that likes dividends, you've been feeding them dividends for a century, And now you tell them, look, we're a technology company, we can't afford to pay dividends, so it's clientele effect. Second, there's a signaling story. If finance and econ is full of signaling theory, but signaling is human nature, right? I mean, if you have an interview, why do you wear an expensive suit? Which is uncomfortable in the summer or in the winter or any time of the year. Because you want to tell the interviewer, look, this is how much I want this job. I've got this expensive suit that I bought for $3,000. I'm wearing this shirt that's choking me while I'm talking to you. But I want this job so much that I'm willing to live through this discomfort, so you give me the job. Life is full of signaling that you send out, right? I'm going to argue that dividends can sometimes operate as a signal to markets about your future. We'll talk about how shaky those signals can become. But the signaling story is, if you pay a big dividend, you're signaling to the market what? That you not only have high earnings, but you expect to be able to maintain those earnings over time. And finally, there is not a noble reason, but a reason that exists anyway, that you might pay dividends to rip off your bondholders. Why does it do it? As a lender to a company, what do you want all cash to do? Stay in the company, right? In fact, when you set interest rates on my loans, you base it on an expected dividend policy. And I'll pay at 30% earnings because that's what I've always done. What if I increase my payout from 30 to 70%? Remember, you didn't put it into the covenants. You didn't stop me from doing it. The day I do that, guess what I've done? I've made myself better off, because that interest rate you set based on a 30% payout ratio is now too low, but you can't go and reset it. That's a wealth expropriation. We'll talk about how this plays out in the dividend discussion, that companies sometimes pay dividends to rip off lenders and bondholders. So next session, we'll talk about good reasons for paying dividends, but remember, we'll quiz in the first 30 minutes class. So I will see you on Wednesday.